So welcome to not the bootcamp in machine learning for finance, but our monthly quantitative finance seminar series, which is proxying as the headliner for day one of the bootcamp. I'd first off, before introducing our speaker, like to thank our sponsors, Waterfront International for sponsoring this seminar series through the years, and Scotiabank through the Center for Financial Industries for their sponsorship as well. With that said and done, I'd like to introduce our speaker, Professor Sam Cohen. Sam is a professor in the Mathematical Institute at Oxford University. He's also the lead in machine learning in finance at the Alan Turing Institute, with a number of other accolades. He is also the current chair of the SIAM Activity Group in Financial Mathematics, and his research spans a broad range of topics, all related more or less to decision under uncertainty and stochastic analysis and control. He's also the author of a very, very well-known book, which if you don't know it yet, you should get it. We call it The Beast. It's Stochastic Calculus and Application, or Stochastic Analysis and Applications. Calculus and Applications. Why is it called The Beast? Well, it's thick, but it also has 666 pages. So. With that, Sam, he's going to tell us all about statistical predictions of trading strategies in electronic markets. Sam, the floor is yours.
Thank you, Seb. Thank you for having me. I'm going to talk about some work that I've been doing with a variety of colleagues. This is a project based partly at the Alan Turing Institute, partly at the Oxford Mann Institute in Oxford, but in partnership with the AFM, the Dutch Authority for Financial Markets, who are the regulator for Dutch markets. So I'm working with a variety of people. So Alvaro Cartea is a colleague in Oxford, as is Leandro Sanchez Betancourt, Rob Kalmans and Leon van Veldhuizen. I'm sorry, Dutch, not going to work. These two guys are at the AFM. They work there in their data science team. And Saad Labyad is a student of mine in Oxford. So what we're going to try and do is something very empirical. There's going to be no proofs, no theorems, no results in this talk. What we're going to try and do is we're going to look at what you can say about individual trading agents if you are a regulator. So why would we want to model individual traders? Well, there's a few possible reasons that a regulator might be quite interested in doing this. They might provide evidence when you try and understand market manipulation. They might allow you to test disruption if there are new algorithms, new ways of trading coming into the market. They allow you to better understand price impact, to build counterfactual trading tapes. What would happen if this person wasn't here? How would others in the market respond? And so on. So the aim of this project really, as I said, is to understand trading behavior, to go down to the micro level and understand how agents are placing trades in an electronic order book. We're looking at real participants in real markets, real timescales, and seeing what can we actually say. All right, so what's our plan of attack? So as the regulator, the AFM has access to a complete summary of trades in the market. They get a data dump from the exchange, which contains in it the identities of every trading method. So every trader, the company that runs that trading method. They have at a regulatory level the algorithm being used. What I mean by that is which pipe into the exchange orders are being sent down. And they know every cancellation, every message sent to the exchange. And that's the data set that we're going to work with. When we saw it, it's anonymized, but we do have, it's anonymized in a way so we can still trace individuals. So we're going to try and build a model for how algorithms post limit orders. That's the first step. We're just going to try and figure out how do you decide to post a limit order. Well, limit orders, there are three main categories, three main properties to a limit order. There's the direction, are you buying or selling? There's the price, how far from the mid price, from the best price are you going to place your order? And there's the volume, how much are you going to place. Those are the three basic characteristics we're going to try and understand. Once we've got a model for this, we're going to build a model for every single algorithm trading in the market separately. So we go through all the algorithms that are trading on one stock, and we build a model for how they trade. We then take all of those models, we're going to cluster them together to try and build some stylized representation so that we can build some understanding of what are the types of trading that we see in the market. Our aim is to give reportable quantitative estimates of algorithm sensitivities. What do I mean by this? I'm not interested in just telling you, well, there are some algorithms that don't like accumulating inventory. We want to be a little bit more precise and say how much do they not like accumulating inventory, and I'd like to be able to do it in a way where I could tell you. Okay, that's going to mean that despite the name of today's workshop, there's going to be very little machine learning in this talk. Okay, so we're using data from Euronext Amsterdam. We have 16 weeks of data that we're just working through in this particular project from the 11th of October 2021 to the end of January 2022. That's the 16 weeks of data we have. We're going to focus on what happens between 9:05 and 25 past 5 in the evening, so that we're avoiding the very open, the very close of the market. We don't need to worry about the cross, etc. In the paper, we consider 4 stocks: ASML, ING, Ahold, and TomTom. But for the talk, we're just going to talk about ASML. They're a big chip manufacturer based in the Netherlands. Well, not manufacturer, they make the things to make the chips. Okay? But they're quite a big company.
Why those 4?
We wanted companies where most of the trading happens in the Netherlands. Okay? These are Dutch equities. They're trading in the Netherlands, and most of the equity is trading there. So I think it's about 50% of, we know, because of the way the regulation works, we know that about 50% of the trading of ASML does occur at Euronext Amsterdam. And so we think that this data is then a reasonable approximation, but it's a big enough company, it's reasonably liquid, there's going to be enough trading that we can actually get somewhere with it. What we have is every action in the order book labeled with algorithm identifier and member identifier. So what do we mean by this? I'll come to the exact definition, but we know who's sending the orders and which computer they're using. The data contains transactions, orders, cancellations, amendments, everything processed by Euronext Amsterdam. Okay, so we're going to focus on ASML, as I mentioned. So this is worth about 200 billion in the period that we were studying. It's traded on about 100 different trading venues, but mostly on Euronext Amsterdam. It's a constituent in a number of indices. The paper has other results, but time is short, so I'm not going to go through everything. Okay, so if we look at this, how many trades? So on Euronext, there's about 42,000 trades a day. So these are actual transactions where someone buys and sells. The average volume per day is €500 million. And over our 16-week period, it goes from just under €600 up to €770 in price. So it's reasonably stable in this period. In particular, the tick size does not change at all because the price is reasonably stable. So it's got a constant tick of 10 euro cents, which is about 1.6 basis points. So that's the tick size that you're able to trade with in this market. Everyone with me? Happy? Excellent. Okay, so how does Euronext operate? Like many markets, there's a bit of a complicated system. We have members of the exchange, the companies. They then have dealing capacities that they're allowed to use. These are contractual agreements between them and the exchange. And we are going to focus on 3 of those. A client, which is where they're trading not for themselves, but on the behalf of a client. House, which is where they're trading on their own behalf. And liquidity provider, where they are trading in a capacity where they say they will provide liquidity to the market. There are 2 other significant dealing capacities, which are retail and retail liquidity providers. Those are a bit weird because they create a separate order book for retail clients who might want to trade. So we're going to effectively ignore any posting in the retail book. We use it only to account to make sure we've kept track of everything that happens, but we're not going to focus on retail dealing capacities. So within a dealing capacity, a company is then allowed to have multiple algorithms. So they can have multiple entities. These entities, we expect, have some human intervention, but survey data certainly suggests, and the speed of transaction suggests, that pretty well everyone is trading in some sense with an automated algorithm. There'll be some level of execution, some level of order placement, which is done automatically by pretty well everybody trading in this market, especially by people who trade a lot. Okay, so as the regulator, what can you see? You can see which entity sends the order. And at a regulatory level, the entities are meant to be certifying that they are not going to change the market, they're not going to lead to market instability, et cetera, et cetera. So we don't know whether the member considers this entity one algorithm or whether they've got a portfolio that they're then selecting from. We don't know, and to some extent, doesn't really matter how they think it works. We're just going to be looking at the entity level, and for the sake of simplicity, I'm going to call that an algorithm and everything that follows. Okay, so what do people actually do in this market? Well, you often hear, the first time you hear limit order books, you get this story, there are limit orders, there are market orders. People trade using these things. There are market orders in this market, but if we look at the numbers, in terms of the number of trades executed, about 97% are limit order against limit order, 1% are market order against limit order, and 1% limit order against market order, depending which direction we're looking, buy or side. And all other combinations, all of your hidden orders, iceberg orders, everything else is 1% of the market. So we're going to ignore all of this market order and everything else. We're just going to focus on limit orders because that's where most of the action is. So we said that, but we have to be a little bit careful because there's more than one type of limit order. In particular, there's two main validities. So the two main validities over this period are immediate or cancel or day validity. So if you post an order with immediate or cancel validity, that means I want to trade now. Whatever doesn't get traded gets dropped, disappears from the book. And if I post with a day maturity, that says I want this order to stay until filled for the rest of the day, until filled or cancelled. And we can see that when we start looking at actual trading, that about a third of the trades happen between day validity and day validity. So these are people who say, I'm going to post an order, I'm happy for it to remain in the book for the rest of the day, but it happens that this executes against another order. And then a third each way, so 2/3, are someone trading with an immediate or cancel versus a day order. Okay, so these are, generally speaking, more aggressive orders when you've got an immediate or cancel. This is someone who wants to trade, if possible, at this price. And all other combinations are less than 2%. So we're not going to think about them too much. Okay. So what about what actually gets posted? What I said a moment ago was what trades. Well, in terms of posting, the picture looks a little bit different. When it comes to posting limit orders, 96% of orders that get sent to the market have day validity, because these are sitting deeper in the order book. They're not things that are trying to trade immediately. They're posting liquidity that's meant to hang around for a while. So 96% of orders that come in have day validity. 4% of orders that come in are immediate or cancel. They want to trade quickly. And in total, there were 660 other orders that came into the market. So we're going to ignore these, but we will talk a bit more about these. But we have to remember, while there's 96% of orders that come in are day validity, as we just saw, 2/3 of trades come from these guys. So most of the trading's coming in through these immediate or cancel orders, even though most of the orders coming in are day validity. I'm sure to many of you this is completely obvious, but it's worth getting it so that we're all on the same page about how these markets work. Okay, so what are we going to look at? We are going to consider everybody who's trading on ASML at Euronext Amsterdam. Now, so there's, I think, 96 algorithms. Yes, it even says it on the slide. So there are 96 algorithms that continue to trade through this period. This is just over the first 4 weeks of data, from the 11th of October to the 5th of November. There are 96 algorithms. Every week, some algorithms drop out, some new algorithms come in. So we're going to work in a rolling window with 4 weeks of data each time and see what happens. So as we do this, we can actually then just sort all the algorithms by how much they're posting, how many orders they're providing. So if we do this, the top 5 algorithms provide 34% of the activity in the market. So a third of the orders coming into the market come from 5 algorithms. That is not even 5 members. That is 5 individual algorithms posting in a reasonably liquid book. If we go a little bit further down, about a bit over half come from the top 10. And if we go down to the top 50, so the top half of the algorithms that are active, they are accounting for 96% of the volume coming in. However, if we start looking at the number of trades, 27% of the trades involve the top 5. Not surprising. If you're posting volume, then you may very well get traded against. So you're included in a trade that happens. But more interestingly, only 74% of the volume comes from the top 50 algorithms. So even though these guys are posting 96% of the orders, there's a definite difference between these two numbers, 96% versus 74%, because it's small guys who rarely post in the book who actually do an outsized number of trades. If we look at the volume, the numbers are even bigger. The difference is even more stark, I mean, in the sense that the trades are often also bigger. So over a third of about a third of the volume comes from the bottom 60% of the bottom 50% of algorithms acting in the book, as opposed to them only providing 4% of orders. Yes, question? Just wait for the mic.
Sorry, just a clarification. How are you calculating the value? Is it just on the actual spot price at that time?
Exactly.
Or, okay, so it's not the actual limit.
No. This is
value.
so here, because volume is only talking about traded volume.
Oh, okay.
So it's just when something's actually trading.
Perfect.
It's not the volume of limit orders. Because to some extent, you could be having people posting limit orders a long way from the touch, which are clearly never going to trade. This should not count as real volume. That's the idea. Okay. So output variables. Let's think about this. Well, we're going to start thinking about trying to track these orders, and we need to think about a few different aspects of the order. So we're going to define 3 things. Oh, that's very weird. The angles are just wrong. So we got D, P, and V, the direction, the price, and the volume of an order. These are the things we're going to try and build a statistical model for. The direction, plus or minus 1. So it's 1 if the order's coming in to buy, minus 1 if it's coming in to sell. Easy. Price is P, the price attached to the order, and V is its volume. Now, we're going to take the volumes, we're going to bucket those just in deciles, so 10 different groups of possible volumes that you could send, rather than trying to deal with the precise volume. Because algorithms seem to do slightly odd things in terms of their volumes. Often they're very consistent with the volumes that they send, as we'll see. But if we just go back to the population deciles, that sort of smooths our model out. The other thing we're going to do is we're going to simplify out the price variable. Prices are difficult to work with, because as we go, the price of the underlying has moved. So if the price has moved over here, you really want to figure out where the price is relative to the mid or relative to the bid ask, etc. So we're going to work with the prices in 3 categories. There are orders that are better than the best bid or ask, depending on the direction that we're working in. Orders that are at the touch, at the best bid or ask, and orders that are deeper in the book. And we're going to focus on those 3 categories of order prices. So just to make that a little bit more clear, the signed difference from the best quote, so we say, let's take how far we are from the best price, and then we say that the price bucket is 1 if you're better than the best price, so you're inside the spread or you're crossing the book, you're looking to trade, and we call these eager to trade orders, because they're somehow better than what's already in the market. Then we have orders that are at the touch, so either at the best bid or the best ask, depending on the direction, and orders that are deeper in the book are category 3. So once we have this, we can note that for ASML, about 10% of orders come in better than the current best price, 42% are coming in at the best price, and 47% are deeper in the book. So how are we going to figure out who's doing what? Well, we need some features, and we thought about this for a while, and we said, let's just go for it. So we came up with 53 different features that we thought possibly could be reasonable predictors of behavior of agents in the book. So these should reflect in some way, remember, we're doing statistical modeling. This is not meant to be perfect. This is meant to give us information. They're useful features. So these are meant to reflect the current state of the limit order book. So is the spread big? Is there a lot of volume in the book at different levels? We might ask about the recent activity of the book. Has the price moved? Have the volumes changed? The current presence of this algorithm in the book. Maybe I choose whether to trade depending on whether I've already got volume in different places. So I'm going to look not just at the state of the order book, but my particular position. Maybe I don't just care about my position, but I'm actually not at the algorithm level, but at the member level, where's my position of the company as a whole in the order book? We'll look at the cash of the algorithm. Sort of have they been making money through the day? Their inventory, have they accumulated a position through the day? And also at the algorithm and at the member level as well. So we look at 53 different things, and then you look at this for a while and you go, oh dear, that's very overcomplete. I'm not going to be able to do very much with it. And so we use PCA because it's the most obvious thing to try. First things first, do something simple. And we projected it down, but we actually needed 30 features to capture most of the variation. So it's still a reasonably big, diverse set of features we're working with. Okay, so what we're going to do, for every algorithm, we're going to use these features to predict the direction, the price bucket, and the volume bucket. Okay, so we're going to just do simple prediction of these facts, given the algorithm is about to trade. So I'm not going to think too much about the timing of trades. That's a different statistical job. Feel free to ask me about it later. But we're going to say, at the moment when an algorithm is about to act, given that information, what do they do? What's the price they choose? What's the direction they choose? What's the volume they choose? We train over 4 consecutive weeks of data. We then move 1 week forward, use that 4 weeks, rolling windows, and go through our 16 weeks accordingly. Yes?
Question is, do you consider all the rows in L1 if, for example, the mid doesn't change for a while? Do you do any sampling to actually capture more active?
Not at the moment. So we really, as I say, we look in the clock of algorithm about to trade. So we're really not trying to capture timing.
So if it happens on a milliseconds and we have many rows that didn't change, it's just, for example, maybe changed by...
So we go through, for each algorithm, for every time they're going to trade in this 4 weeks, we compute all these 53 variables at every one of those times. So we calculate the state of the book, we calculate the state of that particular algorithm and its member. We do that for every time they're about to trade. This is why we're not trying to think about timing too much, because to get a good model for timing, you've got to think about times they chose not to trade. And we're working on this. We don't have the results just yet because it's statistically a pain. Okay. So what do we get? Here's the result. So I'm going to use logistic regression. Okay? First things first, try the simple model, because I'm just predicting a direction, 2 values, a bucket, 3 values, or 10 values. Let's just do this with a logistic regression, see what I get out. Okay, so If I do this, for the top 5 algorithms, I can predict with 65% accuracy which direction they're about to trade. Plus or minus 7% depending on which algorithm it is. There's a range of these. Similarly for the top 10, and as we go down, it actually gets better. My accuracy improves for the algorithms that trade less, and this is the out-of-sample prediction accuracy. I can do, the direction's good, the price is even better, we can figure out where they're going to place their orders at over 80% accuracy among those 3 categories of better than the touch, at the touch, deeper in the book. Volume is not so great, it's 60-odd%. Now I'll point out though, if I move instead from the price to the price given the direction, that improves the accuracy up to about 85%. So if I know the direction you're about to place, I know which algorithm you are, I know the state you're in, about 85% of the time I can tell what price you're going to be posting at. Okay?
Sorry, Sam, quick clarification. So are these logistic regression models trained on just the job of predicting direction and then just the job of the bins?
So yeah, so I train one model to predict the direction, and this is the out-of-sample accuracy of that model.
Right.
I then train a model to predict the price,
Right.
or a price restricted to when you bought, when you sold.
Because
and then,
in principle, you could have a model that tries to predict the triple.
sure,
And then
but
marginalize, right?
life is short. This is easy. I'm going to do this. Yes, I could. You're absolutely right. It probably wouldn't gain too much. It would be that you'd then capture more intricate interactions between them. And we see that a little bit when we look at the conditional model. The reason that the conditional model is better is because it's able to it can distinguish between bid and ask, because it knows which direction you're trying to trade. Now, these are order-weighted average accuracies. Okay. Now, we can compare with some benchmarks. One is a very naive model which says you will continue to do whatever you did most often in the past. Okay? Now, if we do that, we notice a few things. First of all, our direction model is 15% better than something stupid. So it just says do what you did in the past. Our price model is only 8% better, or if you go down to the order-weighted average, only 4% improvement over a very naive model, and the volume model is even worse. So algorithms are actually very, very consistent, particularly when it comes to posting volumes. They like to just keep doing the same thing, and this is for lots of algorithms in the market seem to be doing this. Price, there's a little bit more information. Direction, though, we are getting something noticeably better. We're gaining over about a 50-50 guess. We're moving up to the mid-60s in terms of our percentage accuracies. Just using simple logistic regression. Yes? Just
for price, you're using linear regression, or I mean, how can you
no,
use
because
this?
we're predicting that price bucket. Are you posting inside the spread, at the touch, or deeper? We tried various things, actually. And the problem is that you get algorithms that seem to like posting sort of 20 ticks away from the price. And it's always exactly 20 ticks. And then you say, well, it's very hard for me to build a model when I've got one algorithm that posts 20 ticks, another that posts 23 ticks. Are they the same? Well, sort of, practically. For my purposes, they're the same. But I need to somehow bucket them together. So I actually think that one thing that we're hoping to do in the future is give a slightly more refined price bucketing model where we have something like the best 5 ticks. I think would be particularly interesting, but I don't have that data to share today.
Thank you.
Okay. So this is just with a naive benchmark, and I suppose the key takeaway here is that our direction model is better than random guessing, noticeably better than random guessing. Our volume model really isn't. Okay? Just using the past is just as good a model as anything else. Now, Anastasis has a question.
Thank you. Yeah, so just so since you're using logistic regression, is it possible that the reason that volume and like the second guy.
Price.
Yeah,
Price bucket.
Sorry. Yeah, is it possible why they don't seem to be, I guess, that important or whatever? Like, because maybe the dependency is highly nonlinear. So if you had like some deep binary classifier or whatever, would it be super different?
Let me answer that by going to the next slide.
Awesome.
Okay, so to answer exactly Anastasis's question, we said, well, what if we did go ahead and throw this at machine learning of some sort? So let's try a random forest model. Okay, so we did a boosted forest, and we tried to fit it. And what do you notice? If we compare over the benchmark, we're getting our direction model gets up to 23%, for example. Okay, which is a 5% better than our logistic regression benchmark. In terms of the volume and the price, it's really nothing. There's no advantage over logistic regression that we could find with this sort of data by using the random forests. So there is an advantage for direction, but not so much for price and volume. The problem is I can't show you the results of the random forest because, as I'm sure you will understand, this data is a little bit confidential as it contains exactly the trades of every company that is trading in this market. And there is a problem that if you start using deep machine learning type methods, random forests, neural networks, we know they can reproduce their training data. And so I cannot reliably show you or give you the model that I would fit because it might leak the training data, which would leak the private information, which would make lawyers sad with me. I don't like making lawyers sad if I can avoid it. But I suppose this is something to realize. There is still a little bit of fat left on the table here because you could do a little bit better on the direction model in particular, 5% versus 15% advantage over guessing. Okay. So as I said, it's harder to interpret this. The other thing with random forest, it would actually be it would be tricky for me then to cluster the random forest models to say, here's a stylized action, because random forests, they don't live in a nice space to build clusters, whereas logistic regression, you've just got a vector of coefficients. Okay. So let's talk about clustering. So we're going to take our model coefficients. So what have I got? What does my model consist of? Ultimately, it's just some coefficients of each of these linear regressions, or logistic regressions. So I've got 3 regressions, the direction of the order, the price bucket, and the volume bucket. The first is with logistic regression, the second 2 with multinomial logistic regression. And the idea is that these things should capture information about the behavior of the agent. Okay, the stylized behavior of the agent is captured by these factors. So I'm going to use these coefficients to try and cluster algorithms. And given the performance observed, we cluster using only the direction model.
There's
Marcos.
a question online.
Marcos. Hello.
Hi, Sam. Hi. So when you are saying that the algorithm will continue to do what it was doing, so keeping the direction is not necessarily what it was doing. If you consider that he was going to be buying and selling and trying to capture the spread, the definition of doing what it was doing is not necessarily to keep the same direction of the trade.
Of course. I suppose that was only as a very naive benchmark.
Okay.
So it was deliberately idiotic as a model. No one would suggest that it's a good model, but it's something where I can say, am I at least better than this? And the fact that I'm not better when it comes to price and volume tells me there's probably not so much there.
Okay.
If that
Got it.
makes
Thanks.
sense.
Yeah, thank you.
Okay. So I'm going to use the direction model to build clusters. That's where we are. Okay, and okay, I told you earlier that we had 3 different trading capacities, dealing capacities. So I'm going to try, I have to pick a number somehow. There's various ways to try and decide how many clusters to build, but as we have 3 dealing capacities, let's build 3 clusters. Okay, so I'm going to tell you the punchline of the story and then tell you the story. I know it ruins the punchline, but we're not here to tell jokes. Okay, so cluster 1, I'm going to call directional traders. These are traders who like to accumulate inventory. The fact that they have accumulated inventory already that day, they've moved their position in one direction, is a good predictor they're going to continue to go in the same direction. They also respond to their own position in the limit order book. Their position in the limit order book changes their behavior. They regularly trade aggressively. They'll cross the spread and trade. They use a mixture of passive and active trading. They're not always sending orders that cross the spread. And they do use some deep limit orders. That's cluster 1. Cluster 2, I'm going to call the opportunists, or you could call them deep liquidity. These are trading algorithms that like to post deep in the order book. They generally don't look at their own inventory. Their own inventory change is not a good predictor of future behavior. They respond quite a lot to imbalances in the order book. When they trade actively. They use immediate or cancel orders, and they often cross the spread. Okay, so they're posting volume deep in the book, but when they trade, it's by crossing the spread. They like to stay balanced deep in the book. They like to have a position on both sides of the market. And when they're trading, mainly immediate or cancel orders near the touch. They're not leaving volume near the touch in the book. So cluster 3 are your classic market makers. They trade at the touch. They mean revert their inventory. So if they've accumulated something in the day, they're going to bias their trade so that their inventory goes back down. They like to be net zero at the end of the day. They like to balance the volumes they have at the touch. So if they've got volume on one side, they'd like to generally increase the volume on the other side. They usually trade passively. Very rarely use immediate or cancel orders. They're generally using day orders. They rarely cross the spread. If the spread opens up, these are the guys who are going to post orders inside the spread to refill it, and they send a lot of orders. So this is where these are the guys doing market making in the melee of the middle. Okay, so that's the end of the story. Now I'll tell you why I believe this to be true. Okay, so the clusters look like this. If I go through my 16 weeks of data, I'm going to focus on the first week, but what we can see is that as we go through, there is some consistency. So cluster 1, algorithms that are cluster 1, there is a consistent group that's always clustered together. Cluster 2, this is these opportunists. They seem to fluctuate as I change which week I do my regressions on. There's a lot of error and noise and the clustering changes and all of these things. And sometimes there's more of these algorithms that get put into cluster 1. Sometimes there's more put into cluster 2. On the other hand, cluster 3, these market makers are fairly consistently separate. There's a little bit of, oh, is this a cluster 1 or cluster 3? But there's almost no movement between clusters 2 and 3. There's a little bit here. That's really the only time where there's any confusion whether an algorithm could be cluster 3 or cluster 2. There's a sort of clear distinction there in the quantization of what people are doing. Okay. Yes, question.
Can an algorithm switch clusters across time?
So because we're going to run each of these experiments over 4 weeks, test on the next week, and then we're going to roll everything forward. So if you think over one 4-week period and the next 4-week period, well, there's 3 weeks overlapping, so it would be hard to change. But over this 4 weeks and this 4 weeks, there's no relationship between the models we fit, so it could do in principle. Okay, so how many algorithms are we? You'll notice 54, so just in the first week, 54 of the algorithms are cluster 1. These are guys who are accumulating inventory through the day. 25 are cluster 2, these opportunists, 17 are cluster 3. We can look at who's sending orders. You'll see cluster 3, despite there only being 17 of them, they send about as many orders as everybody else in the market combined. If we look at the number of trades, everyone's about equal. Again, even though cluster 3 is substantially smaller, their orders to trade ratio, so how many orders they send in divided by how many trades they do, you'll notice cluster 3 is quite a lot higher. Cluster 2 sends in more orders than they trade, about 5 times, but cluster 1 sends only 3 times more orders than the trades they make. A few things, one other statistic here that's quite interesting is the liquidity taking trade count. How many times do they trade in a liquidity taking way as the aggressive, the active partner in the trade? you'll notice that the percentage of this is only 26%. So 75% of the time these guys trade, cluster 3, they're trading because someone has come to them. They've left liquidity in the book, someone has come to them. On the other hand, these opportunists, when they trade, 73% of the time it's because they've gone out to make a trade rather than someone coming to them. And it's about 50-50 for cluster 1. You can also look through the imbalances, etc., and the directionality. So what's the ratio of their total trade in the day versus the total volume traded, the net trade versus the total trade. And you can see cluster 3 generally are the least directional of the groups. Okay, what can we say about the direction? So if we look at the key predictors of direction are the imbalance of the algorithm. In most cases, it's do I already have volume on one side of the book or the other? So you can see that cluster 1, if it has imbalance, it continues to grow imbalance. Cluster 3, if there's imbalance, it tries to mean revert it. Cluster 2 generally mean reverts. Interestingly, cluster 3 likes to grow imbalance deep in the book. Not exactly sure why that would be. The cash and inventory, these are highly correlated, so the way we get these numbers out, I wouldn't put too much distinction between them. The thing to note is that cluster 1, their inventory is a strong predictor of future behavior. Cluster 2 doesn't seem to really care about its inventory. Cluster 3 likes to mean revert its inventory. And then you can see they actually react oppositely, clusters 1 and 2 and clusters 3, to the volumes at the bid and the ask. So they reverse their behavior, which is really because cluster 3 are trying to stabilize the market, add volume back in when there's a spread, whereas clusters 1 and 2 are liking to actually trade. Okay, that was direction. What about price? Well, price limits, let's look through these price buckets. So remember, there's the eager to trade, best bid, and deeper in the book. And what we can see is that cluster 2 likes to put a lot of its trades at the best bid. So it's adding volume near the touch, some deeper, very rarely eager. On the other hand, cluster 2 is posting a lot of volume deeper in the book and only a few at the touch or more eager. We can look at the model that predicts these directions. A couple of things. So this is saying, do you like to trade eager to trade? Well, cluster 3 does not like to trade eagerly. Minus 7.4 is the intercept in my logistic regression. So it says, no, don't do that. But on the other hand, if there's volume at the bid, given they're going to post a buy order, they respond positively to there being volume at the bid, and conversely, if they're posting a sell order, they respond positively to volume at the ask. They also respond quite positively to the spread. If there's spread, they like to post inside. What about posting at the touch? Well, cluster 3 likes to post at the touch. No one else likes to post at the touch. And what about posting deeper in the book? The key standout here is cluster 2, who really like to post things deep in the order book. Okay, so let's think a little bit more precisely now just about those orders which are eager to trade. So they're better than the current best price. And we can say, well, there are 3 possible things that could happen when such an order is sent. It could be that there's an aggressive trade, you cross the spread and actually trade against the other side. It could be that you generously provide liquidity. You post an order, you post it with a day maturity, it stays in the book, and the spread now changes. Or it could be that you send an immediate or cancel order, inside there's no one to trade with, and so you miss. Those are really the 3 possible outcomes that can happen when you post better than the best price. And we can again say, let's build a model for this event, given you're posting at better than the best price. And you'll be very surprised to learn we're going to do it with yet another logistic regression. Okay, well, before we do that, let's just see the statistics. Cluster 2 ascending, if they are sending orders better than the best touch, 84% of the time they send an immediate or cancel. So they are not posting volume inside the spread. They're not refilling, they're not adding sort of trying to tighten the world, if they post better than the best price, they are posting to trade with an immediate or cancel order. On the other hand, cluster 3 basically never does. They're not trying to trade inside the spread, they're trying to refill, they post with a day validity order. If we look at the outcomes of what happens, well, most of the time, clusters 1 or 2 successfully trade. Cluster 3, on the other hand, leaves volume inside the spread when they do this. So if they go better than the best price, it's because they're leaving volume inside the spread. And in this case, there's very few missed attempts for this market. We can see where overall everyone's posting, if we think not now at the touch, but where are most of the posts happening. And you can again see that cluster 3, these market makers, they're posting almost all of their volume here, whereas clusters 1 and 2, they post generally between 0 and 5 ticks from the touch. There is, though, quite a bit of a tail. It goes out to about 100 that people do seem to trade there. Okay. We can build our directional model. So this is the model for the directions of what happens when they trade. All these tables are in the paper. If you want to go and have lots of fun reading tables of data, be my guest. So now let's finish, and we chose 3 clusters. Why? Because there are 3 dealing capacities. So how do our clusters align with the dealing capacities? Well, client algorithms are almost entirely cluster 1. Not surprising, they're trying to actually execute to build inventory. Occasionally they act like cluster 2, but pretty much all the time they're cluster 1. House trading, similarly, is cluster 1, and maybe sometimes cluster 2. But what we found interesting is that liquidity providing algorithms are equally spread between all 3 clusters. So a dealing capacity of liquidity provider does not mean you behave like a market maker and post volume inside the spread. That happens with about 16 algorithms. All the rest of them are posting volume deep in the book and then actively trading and taking liquidity away at the touch, or they're accumulating positions and trading accordingly. So we actually get quite a confused model here, which surprised us that we were not recovering from looking at behavior really anything to do with the dealing capacity of companies trading in this market. Now we can even go further and we can start looking by member what's going on. So here's all the different members, or a selection of the members trading in this market. On the left-hand side of this plot, we have their dealing capacities. So if it is green, they are client algorithms. If it's blue, they are house. And if it's pink, they are liquidity providers. That's on the left. On the right is our clustering. If it's yellow, it's cluster 1. They like building inventory. If it's 2, they're white. They are trading deep in the book and then aggressively trading. At the center, they're posting deep liquidity. And cluster 3 are your market makers who actually post liquidity near the touch. And what you can see is, well, there's a lot of liquidity providers who are in cluster 1. And in fact, you often get, for example, at the top here, you've got a company who has 5 algorithms, all of which are technically liquidity providers. One of them looks like cluster 1, 2 of them are doing this deep action, and only 1 is really market making. And that's from 1 company. And so we can see there is some confusion about what's going on in terms of, does the dealing capacity reflect what companies do? Okay, well, I'm nearly at time, so I'm going to finish. Using the factors that describe trading direction seems to classify algorithms well. So all of this classification was done using only trying to predict, are you going to buy or sell given your state? So we were then able to use that classification to say, what do you do in terms of where do you post volume, what prices do you use, what are the outcomes, what types of trades do you use? We did that all on the basis of, do you buy or do you sell? And that seems to actually be enough information to classify things quite well. Liquidity providers, in the contractual sense, display a wide range of trading activities. Some of which corresponds to stylized market making, about 1/3. but 2/3 of which looks quite different to what we would learn if we read the book by Sebastian Jaimungal and Alvaro Cartea and Jose Penalva about algorithmic trading, and we said, what does a market maker do? 2/3 of liquidity providers don't look like that. Various features are important for different algorithms. It's not like there is one set of features that everyone is really looking at. It does vary depending on the type of algorithm we're talking about, and this, we hope, allows us a better understanding of typical behaviors in the market. So for further discussion, please see the paper. It's on SSRN, and we hope to have more output from this project coming fairly soon. Thank you.